everyone, welcome back to our channel and welcome back to this update video. In this brief update video, we wanted to share with you the foreign official treasury liquidation. The foreign official treasury holdings at the New York Fed have declined by $82 billion since late February, reaching levels not seen since 2012. Oil importing economies including Turkey, India, and Thailand are liquidating dollar reserves to fund elevated energy costs following the closure of the Strait of Hormuz. Central banks are simultaneously intervening in currency markets to limit depreciation and contain the local currency fuel price inflation. And the Treasury yields have risen sharply as the foreign official selling compounds existing inflation concerns, raising borrowing costs across the economy. With this context, let's start with the reserve liquidation mechanics. The New York Federal Reserve serves as the primary custodian for the foreign official institutions holding of U.S. government securities. This infrastructure, which includes central banks, sovereign wealth funds, and the international organizations, has historically provided a stable base for demand for the Treasury issuance. The custodial holdings function as real-time barometer of global dollar reserve management, with changes reflecting both portfolio decisions as well as foreign exchange intervention activity. The scale of the current drawdown is important even in historical context. While the Treasury market has roughly tripled in size since 2012, the foreign official holdings at Fed have now returned to levels last seen that particular year. This divergence underscores a structural shift in the composition of Treasury demand, with foreign private investors and domestic institutions absorbing an increasing share of issuance as official sector participation has waned. And this brings us to the energy shock transmission channels. The closure of the Strait of Hormuz has triggered a surge in the global energy prices, creating immediate balance of payments pressure for oil importing economies. Countries must now source larger dollar quantities to pay for the same volume of oil imports, depleting foreign exchange reserves and forcing difficult fiscal choices between subsidizing domestic fuel prices or allowing household energy costs to increase. Turkey's response illustrates the magnitude of this particular pressure. The central bank has liquidated $22 billion in foreign government securities since the conflict began, and a substantial portion of which is likely consisted of U.S. Treasuries. India and Thailand have similarly drawn down foreign exchange reserves, though the precise composition between the Treasury holdings and the dollar deposits remains unclear from the available data. There is also a currency defense dynamics that is involved out here. Beyond the funding of oil imports, central banks face secondary pressure to defend their currencies against dollar strength. Currency depreciation creates a self-reinforcing inflationary spiral. Weaker local currencies increase the cost of dollar-denominated oil, which further pressures current account balances and places additional downward pressure on the exchange rates. Many central banks have opted to intervene in the foreign exchange markets to limit this depreciation, selling dollars and purchasing local currency. This intervention requires drawing down on the dollar reserves typically held in liquid instruments such as treasuries. The result is a coordinated, if unintentional, pattern of treasury liquidation across multiple emerging market economies simultaneously. Next, let's look at the market impact and the yield dynamics. The foreign official selling arrives at a particularly sensitive moment for the treasury market. Traders are already positioning for higher inflation expectations driven by energy costs, pushing yields higher across the curve. Both 2-year and the 10-year Treasury yields have risen by the largest monthly increment since 2024, reflecting a fundamental repricing of the inflation risk. The combination of inflation-driven selling by private investors and liquidity-driven selling by foreign officials compounds the yield pressure. The higher Treasury yields translate directly into increased borrowing costs for the federal government, corporations, and households, creating a secondary economic headwind beyond the direct impact of elevated energy prices. Let's wrap up this update with the strategic outlook. The current episode accelerates a longer-term trend of official sector diversification away from dollar-denominated reserves. As foreign reserve managers allocate incrementally to alternative assets and currencies, the marginal buyer of treasuries has shifted towards foreign private investors and price-sensitive domestic institutions. The structural change implies a higher equilibrium yield level and greater volatility during periods of stress. For the oil exporting nations, the picture is more nuanced. While higher prices generate windfall revenue, some Gulf states may nonetheless liquidate treasury holdings to fund domestic spending commitments or stabilize regional currencies. The net impact on treasury demand from the Middle East will depend on the duration of the conflict and the fiscal response of individual governments. The market participants can monitor the weekly Fed custody data as a leading indicator of the official sector flows. Continued liquidation would reinforce upward pressure on the yields, while stabilization could signal that most acute balance of payments pressures have passed. Either outcome carries implications for rate expectations and the path of the monetary policy. Now, that's what we wanted to share with you in this brief update. Stay tuned in for our next one.